macro currency signals.
Most people hear numbers like $1,500 to $50,000 and immediately think speculation or fantasy. But real wealth has never been built on excitement. It's been built by understanding value before the crowd, recognizing scarcity before headlines, and positioning during periods of silence. Today, that quiet opportunity exists in one place most investors are still ignoring: physical silver. Most investors believe that the best opportunities are loud. They think opportunity announces itself through headlines, trending charts, and constant discussion. In reality, markets work in the opposite direction. By the time everyone is talking, the opportunity is usually already priced in. History shows us a repeating pattern. When an asset is popular, excitement is high, prices are rising, confidence feels justified, and participation is crowded. At that stage, upside becomes limited because most of the buying has already happened. Risk increases, but it is disguised by optimism. This is where many investors enter, believing momentum equals safety. The real money, however, is made much earlier, during the quiet phase. Quiet phases feel uncomfortable. Nothing dramatic is happening. Prices move sideways, attention fades, analysts stop talking. Media moves on to something more exciting. Assets in this stage are often labeled boring, dead, or irrelevant. But this is precisely the environment where long-term value is built. Silver sits in this exact position today. It is not flashy. It is not trending daily on financial media. It does not generate excitement on social platforms. And because of that, it is ignored. But being ignored does not mean being weak. In markets, neglect and undervaluation often go hand in hand. Assets don't become undervalued because they are broken. They become undervalued because attention has moved elsewhere. Capital chases stories, not structure. When those stories fade, capital leaves, even if fundamentals quietly improve underneath. This is where discipline separates investors from speculators. Most people wait for confirmation. They wait for price to rise. They wait for validation from the crowd. But by the time confirmation arrives, the asymmetry is gone. Risk has increased and reward has compressed. Early stages never feel exciting. They feel slow, frustrating, and uncertain. That discomfort is not a flaw. It is the entry cost. Silver's current silence is not accidental. It reflects years of disinterest, skepticism, and misunderstanding. Gold receives the prestige and headlines. Silver is treated like an afterthought. That perception suppresses participation and keeps valuations disconnected from reality. But markets do not stay disconnected forever. When an asset is fundamentally strong yet ignored, pressure builds quietly. Capital may not be flowing in yet, but conditions are forming. Supply tightens. Demand stabilizes or grows. The imbalance does not announce itself immediately. It waits. This is why the biggest moves rarely begin with excitement. They begin with silence. Silence allows accumulation. It allows patient participants to build positions without competition. It removes emotional noise. Weak hands lose interest. Strong hands gain control. When the shift finally happens, it feels sudden, but it was years in the making. Understanding this principle changes how you view opportunity. Instead of asking, what's moving, you start asking, what's being ignored? Instead of chasing momentum, you study structure. Instead of reacting, you position. Silver today represents this quiet phase almost perfectly. It is overlooked, discounted, and dismissed, yet structurally relevant and fundamentally necessary. That combination is rare, and in markets, rarity is where asymmetric opportunity is born. The uncomfortable truth is simple. If an opportunity feels obvious, it's probably late. If it feels boring, quiet, and ignored, it may be early. And early is where real wealth is built. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Share your location and local time, and I'll catch you in the next one. Most people think of silver the same way they think of gold, as a precious metal that sits in vaults, stored for value, waiting for price appreciation. That assumption is one of the biggest reasons silver remains misunderstood and undervalued. Silver is not just a monetary asset, it is an industrial necessity, and that distinction changes everything about its long-term value. Gold is primarily held, silver is primarily used. This single difference separates silver from almost every other hard asset. Silver's unique physical properties, its conductivity, reflectivity, and antibacterial characteristics make it irreplaceable in modern industry. It plays a critical role in electronics, medical equipment, solar panels, electric vehicles, and emerging technologies that define the future of global infrastructure. Every smartphone, every circuit board, every advanced medical device relies on silver in some form. The global push toward renewable energy adds even more pressure. Solar technology, in particular, consumes silver at scale, and as energy systems expand, that demand does not disappear, it compounds. Here's the key point most investors miss. When silver is used, it is often gone. Unlike gold, which is recycled, stored, and hoarded, much of the silver consumed in industry is not economically recoverable. It ends up dispersed in tiny quantities across billions of devices. Once embedded, it rarely returns to the market. That means silver is constantly leaving available supply, quietly and permanently. This creates a structural imbalance that does not show up immediately on price charts. Supply does not adjust easily. Mining silver is not simple, fast, or cheap. Ore grades have been declining for years. Extraction costs continue to rise. New discoveries are becoming rarer and more expensive to develop. At the same time, industrial demand does not pause during economic slowdowns. Technology adoption does not reverse. Medical usage does not disappear. Energy transitions do not stop. Silver sits at the intersection of past and future. It carries thousands of years of monetary history, yet it is deeply embedded in modern innovation. That dual role is unique. It means silver is demanded both when systems are stable and when they are stressed. Few assets function in both environments. This is why silver cannot be evaluated like a traditional commodity. Commodities are often cyclical, based on economic growth alone. Silver's demand profile is broader and more resilient. Even when investment demand fluctuates, industrial consumption continues to draw down supply in the background. The market often underestimates slow, steady pressure. It focuses on immediate catalysts and short-term narratives, but long-term value is shaped by what must be used, not what is optional. Silver is not optional for modern life. It is embedded into the systems that power global productivity. Over time, necessity creates leverage. When supply is finite and demand is non-negotiable, price becomes the adjustment mechanism. Markets do not resolve imbalances quietly forever. They ignore them until they can't. This is why silver's industrial role matters so much. It turns silver from a speculative asset into a structural one. It means the metal does not rely solely on investor sentiment to maintain relevance. Its utility ensures persistent demand, regardless of market cycles. Silver's power lies in this quiet reality. It is consumed, essential, and increasingly difficult to replace. While investors debate price and volatility, the real story unfolds beneath the surface, ounce by ounce, device by device. That is not hype, that is necessity. One of the most misunderstood aspects of silver is how inflexible its supply really is. Many investors assume that if prices rise, production will simply increase and balance the market. That assumption works in theory, but in the real world of mining and extraction, it breaks down quickly. Silver supply cannot respond on demand, and that rigidity is what creates asymmetric upside. Silver is not mined like a manufactured product. It cannot be scaled with a software update or expanded with policy decisions. It must be discovered, extracted, refined, transported, and stored. A process that takes years, sometimes decades. From exploration to production, the timeline is long, capital-intensive, and uncertain. By the time new supply reaches the market, conditions have often already changed. Compounding this challenge is the reality that most silver is not mined on its own. A large portion of global silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. This means silver supply is indirectly controlled by demand for entirely different commodities. Even if silver prices rise sharply, miners cannot instantly increase silver output unless it aligns with broader base metal economics. At the same time, mining conditions are becoming more difficult. Ore grades have been declining steadily. Extracting the same amount of silver today often requires moving and processing far more material than in previous decades. Energy costs are higher. Environmental regulations are stricter. Capital requirements continue to rise. Each of these factors pushes production costs upward and limits how much supply can realistically come online. New discoveries are also becoming rarer. The most accessible deposits were found long ago. What remains is deeper, more complex, and more expensive to develop. Even when discoveries occur, turning them into producing mines involves years of permitting, infrastructure development, and financing. Supply cannot surge quickly, even in favorable price environments. On the demand side, pressure continues to build. Industrial consumption steadily draws down available above-ground inventories. At the same time, investment demand can shift rapidly when conditions change. Unlike supply, demand can increase almost instantly. A shift in sentiment, confidence, or macroeconomic conditions can bring new buyers into the market overnight. This mismatch between slow-moving supply and fast-moving demand is where silver's asymmetric potential emerges. Markets do not adjust these imbalances gradually forever. For extended periods, prices can remain disconnected from fundamentals. But once inventories tighten and availability becomes constrained, price becomes the release valve. When that adjustment occurs, it tends to be fast and aggressive, not slow and orderly. Silver's relatively small market size amplifies this effect. Compared to major asset classes, silver requires far less capital to move. Modest inflows can have outsized impact. When multiple forces converge, constrained supply, rising industrial demand, and renewed investment interest, price moves can become compressed into short time frames. This is why silver's major bull markets are remembered for their speed rather than their duration. Long periods of stagnation are followed by sharp repricing. Those who wait for visible confirmation often find themselves reacting rather than positioning. Asymmetric opportunity exists when downside is limited by structural constraints, but upside is open-ended. Silver fits that profile. Supply cannot flood the market quickly, but demand can escalate suddenly. That imbalance favors those who understand structure rather than chasing momentum. Supply constraints are not a temporary issue. They are a defining feature of silver's market. And over time, markets always resolve structural pressure through price. That is the quiet force behind silver's potential. At the surface level, paper silver and physical silver appear to represent the same thing. They often track similar prices, move on the same charts, and are quoted interchangeably in financial media. This creates the illusion that exposure is the same as ownership. In reality, paper silver and physical silver are fundamentally different assets, carrying very different forms of risk, control, and value. Paper silver exists as a financial construct. It comes in the form of futures contracts, exchange-traded funds, derivatives, and synthetic products. These instruments are designed for convenience. They are easy to buy, easy to sell, and they fit neatly into modern brokerage systems. For traders and institutions, paper silver provides speed and liquidity. But convenience comes with dependency. Paper silver represents a claim, not the metal itself. Its value depends on a chain of counterparties, clearing mechanisms, custodians, and market liquidity. It assumes that contracts will be honored, systems will function smoothly, and settlement will occur without disruption. As long as markets remain calm, these assumptions go largely unchallenged. Physical silver does not rely on any of this. It simply exists. When you hold physical silver, there is no intermediary between you and the asset. No promise needs to be fulfilled. No counterparty must perform. Ownership is direct, tangible, and final. This distinction becomes critically important during periods of stress, when systems that seem stable begin to show strain. History repeatedly demonstrates that paper markets behave very differently under pressure. Liquidity tightens, spreads widen, volatility increases. In extreme conditions, trading halts, margin calls, or cash settlements replace physical delivery. These outcomes are not failures of the system. They are features of how leveraged markets protect themselves. Physical silver cannot be created with a keystroke. It cannot be settled in cash if demand shifts toward delivery. Every ounce must be mined, refined, transported, and stored. That process embeds real cost and real scarcity into each unit. This cost structure creates a natural floor beneath long-term value. Paper markets, on the other hand, can expand far beyond physical supply. Multiple claims can exist on the same ounce of silver. This leverage suppresses true price discovery as long as participants are willing to settle in cash rather than demand the metal itself. The system functions smoothly until confidence changes. When investors move from speculation to preservation, behavior shifts. The question stops being, what is the price today? And becomes, can I actually get the metal? At that moment, availability matters more than charts. Premiums rise. Inventories thin. The paper price becomes less relevant than the real-world cost of acquisition. Physical silver also removes layers of risk that are often underestimated. There is no counterparty risk, no margin calls, no forced liquidation, no reliance on market hours or electronic systems. Ownership remains intact regardless of market conditions. This is not about fear or extreme scenarios. It is about structure. Modern financial markets are complex, interconnected, and highly leveraged. When disruptions occur, whether from economic shocks, policy changes, or liquidity events, assets with fewer dependencies behave differently. Physical silver sits largely outside the financial system. That separation is not a weakness. It is a feature. Behavioral incentives also differ. Paper silver encourages short-term thinking. It invites trading, speculation, and emotional decision-making. Physical silver encourages patience. You do not day trade bars and coins. Holding physical metal naturally aligns investors with long-term value rather than short-term noise. At its core, the choice between paper and physical silver is a choice between convenience and certainty. Paper offers speed and exposure. Physical offers control and permanence. In an environment where trust in systems is increasingly tested, that difference carries weight. Ultimately, ownership of reality outlasts promises. And when markets are forced to choose between the two, reality always reasserts itself. Financial markets move in cycles, not straight lines. Yet most investors behave as if today's price action defines tomorrow's outcome. This short-term focus is one of the main reasons people consistently enter markets at the wrong time. Cycles do not reward emotion or urgency. They reward patience and discipline. Silver's history makes this clear. Every major silver cycle has followed a familiar pattern. Long periods of stagnation are followed by brief but powerful advances. During the quiet phases, prices drift sideways, volatility fades, interest disappears, analysts turn negative, headlines become dismissive, these periods feel unproductive, even frustrating, but they are not meaningless. They are formative. This is the accumulation phase. During accumulation, strong hands build positions quietly, while weak hands lose interest and exit. Price action provides little excitement, which discourages speculative behavior. This environment filters participants. Those who remain are not chasing momentum. They are positioning based on value and structure. Silver has spent years in this phase. To many observers, this looks like underperformance. But in market structure terms, extended basing is not a sign of weakness. It is a sign that supply and demand are slowly rebalancing beneath the surface. When an asset trades within a wide range for an extended period, it allows pressure to build without releasing it through price. Gold typically moves first in precious metal cycles. It attracts early attention and validates the sector. Silver follows later, but when it does, it tends to move with far greater intensity. This is not coincidence. Silver's smaller market size and tighter supply amplify momentum once it begins. By the time silver's strength becomes obvious, the cycle is often well underway. Emotional investors struggle during early stages because nothing feels confirmed. Rallies are short-lived, pullbacks are frequent, sentiment remains skeptical. This environment tests patience and conviction. Many participants enter too early without understanding structure, then exit too soon out of frustration. Cycles are designed to discourage the majority. Negative narratives dominate during basing phases. Silver is called volatile, unreliable, or irrelevant. These narratives persist until price changes force perception to adjust. Importantly, perception does not create the move. It follows it. By the time stories turn positive, much of the repricing has already occurred. Technical structure often reveals what headlines hide. Compression, higher lows, and long-term basing patterns reflect growing pressure. These patterns do not guarantee outcomes, but they signal increasing probability. When improving fundamentals align with constructive structure, the risk-to-reward profile shifts asymmetrically. Another critical element of cycles is behavior. Investors tend to project recent performance indefinitely. When silver underperforms, it is assumed it always will. When it begins to outperform, enthusiasm accelerates rapidly. This emotional swing fuels late-stage rallies, drawing in participants after the majority of gains have already been captured. The disciplined approach is counterintuitive. It involves recognizing the cycle early before confirmation. It means accepting periods where nothing appears to happen. It means resisting the urge to react to short-term noise. Cycles do not announce themselves. They do not ring bells at bottoms or issue press releases at beginnings. They reveal themselves gradually through structure, behavior, and capital flow. Silver today shows many characteristics associated with early-stage cycles: prolonged basing, improving demand dynamics, and growing sensitivity to macroeconomic pressures. Those who understand cycles are not trying to predict exact timing. They are aligning with probability. Patience is not passive, it is strategic. And in markets like silver, patience is often the most underappreciated advantage of all. When people hear a phrase like, from $500 to $50,000, the instinctive reaction is skepticism. It sounds like speculation, leverage, or unrealistic expectations. But in reality, meaningful wealth creation has rarely been about luck or prediction. It has always been about positioning, entering the right structure at the right stage of a cycle. Positioning means understanding where value exists before it becomes obvious. Markets are forward-looking mechanisms. By the time a story is widely accepted, price has already adjusted to reflect it. The majority of participants enter when uncertainty has been removed, but uncertainty is precisely what creates asymmetry. Early-stage opportunities feel uncomfortable because outcomes are not yet confirmed. That discomfort is not a warning sign. It is the source of potential. Silver today represents this type of positioning opportunity. The metal is priced as if it is optional, outdated, or irrelevant. Yet structurally, it is anything but. Silver is scarce, essential, consumed, and increasingly difficult to produce. Demand exists on multiple levels: industrial, monetary, and strategic. At the same time, supply is constrained by physical realities that cannot be altered quickly. This creates a defined risk environment. Downside is limited by real-world cost structures and necessity. Upside, however, is open-ended. When an asset is undervalued relative to its role in the global system, repricing does not happen incrementally. It happens when perception finally aligns with reality. Positioning also involves choosing the right form of ownership. Physical silver removes layers of uncertainty that accompany financial instruments. It is not dependent on counterparties, leverage, or system stability. Ownership is direct. This matters because positioning is not just about price appreciation. It is about retaining control when conditions change. Many investors confuse activity with progress. They trade frequently, react emotionally, and seek constant validation from price movement. Positioning in physical silver encourages the opposite behavior. It promotes patience, discipline, and long-term thinking. You are not trying to time every fluctuation. You are aligning with structure. Small capital can lead to large outcomes when it is placed where leverage already exists. Silver has built-in leverage due to its relatively small market size. It does not require massive inflows to move significantly. When capital shifts toward it, even modestly, price responds disproportionately. This is why silver bull markets are remembered for speed. Years of quiet positioning are followed by rapid repricing. Those who entered early are not chasing, they are managing exposure. The difference between speculation and positioning lies in intent. Speculation relies on short-term movement and timing. Positioning relies on understanding. It accepts uncertainty in exchange for asymmetry. Importantly, positioning does not require predicting collapse or crisis. It simply acknowledges that financial systems are stretched, debt levels are rising, and confidence fluctuates. In such environments, assets with real utility and finite supply tend to regain relevance. From small capital to large outcomes is not a promise. It is a possibility created by alignment. Alignment between structure, demand, scarcity, and cycle. Silver offers that alignment. Those who position early do not need constant reassurance. When the shift happens, their work is already done. They are not asking whether the opportunity is real. They are already holding it.